अखंडमंडलाकारं व्याप्तमेन चराचरं तत्पदं दर्शितं येन तस्मै श्री गुरुवे नमः. Dear learners, welcome to the course on Essentials of Financial Management. Here we are in the process of discussing the different techniques on capital budgeting, which is required by any firm in order to analyze and select the long term investment proposals. Today we shall discuss the techniques for capital budgeting for risk free projects, and here in the process of discussing the different techniques, we will take first the non discounted technique and thereafter we shall devote our period to the discounted cash flow techniques. Here under the non discounted cash flow technique, the emphasis would be on average rate of return, simple payback period method, and also on the discounted payback period method. So, let us start with the definition or the concept of non discounted cash flow technique. As the name is suggesting, here these techniques will not consider the time value of money principle when it is going to analyze and compare the cost and benefit of the projects. So, there are three main considerations why it is called the non discounted cash flow technique. The number one is it is not giving any consideration to the time value of money principle. That means a rupee received today is equal to the rupee received tomorrow, but this is not true in the real life situation because of the fact that a money received today can be invested in some projects whereby a rate of return would be generated for the company. Second thing is no discounting of cash flow technique. So, in order to consider the time value of money principle, any future cash flows are converted to their present value. Why they are converted? Because when we are comparing the cost with the benefit of the projects, both the units should be equally identical. That means, if we are investing a rupee today, then the future cash flow should also be converted to its present value, so as to make the comparison logical and the meaningful. Now, we shall start with the first techniques of non discounted techniques of capital budgeting. Here the technique is known as the average rate of return method. This method is also known as the accounting rate of return method, which is used for ranking the capital investment projects, which is going to rely on the rate of return each project will earn over its life. This technique will be using the accounting statement or the financial statement comprising of balance sheet and also the income statement. The formula for calculating the average rate of return or the accounting rate of return can be the average annual net profit upon original investment multiplied by the 100. So, here average annual net profit is nothing but the average of the income that have been generated from the project over a series of years, and as a denominator we will take the average investment, where it is the beginning investment plus the ending investment divided by the 2, and this whole output would be multiplied with 100 in order to get a rate of return. For example, the XYZ Limited is making the proposal for either investing in machine A or in machine B. There are certain important indicators, there are certain important highlights of the proposals. The life of the machine A is 3 years, where the machine B also has the life of 3 years. Both the machines require an investment outlay of 2 lakhs. Now, let us see the pattern of income generated from the project, where the machine A is generating 1,60,000 in the first year, 1,20,000 in the second year, and only 80,000 in the, but machine B is generating 40,000 in the first year, 1,40,000 in the second year, and the 2 lakhs in the third year. Now, from this information we would show you how the average rate of return is calculated using the formula that we have already discussed, and we will let you know how the decision of accepting or rejecting the project would be taken. See, the calculation would involve the first the average income after tax. So, if you look at the pattern of income generated from the project A, we would take 1,60,000, 1,20,000 and 80,000, then adding up these figures together, then dividing it by 3, that is the number of years, would give us the 1,20,000 as the average income from the machine A. Now, if we have to calculate the average investment, we have got just one figure, the 2 lakh investment that is required to purchase the machine A. Now, if we have to average investment calculation to be come into picture, it will be 2 lakh divided by 2. So, average investment would be only 1 lakh. Now, keeping these figures into formula, we will get 1,20,000 divided by the 1 lakh and the whole would be multiplied with 100. So, here we can see that the average rate of return from machine A will be 120% or 120%. So, let us look at the average rate of return from the machine B. So, average income after tax would be 40,000 plus 1,40,000 plus 2 lakhs divided by 3, which is 1,26,667. Now, average investment would be calculated using the similar formula that we have used for the machine B. So, 2 lakh divided by 2 will give us the average investment as 1 lakh. Now, average rate of return can be calculated by taking the average income upon average investment multiplying with 100, and here it is coming out to be 126.7%. I hope the calculation part is clear to everyone, because it is very simple. If we just have to take the average of income that the project is generating over the years, divided it by average investment, multiply it with 100, and now we get the rate of return. Now, the decision would be based on the comparison of ARR from the project A and from the project 2. Now, we can look at the figure. The average rate of return of machine B is higher than that of machine A. What is it? It is 126.7% from machine B, which is higher than 120% from the machine B. So, the project A and machine could have been compared using the ARR method. Now, if we put the same values into this table, we can see the details of machine A and details of machine B, and it is giving a bird eye view picture of the calculation that we have used for calculating the average rate of return. Now, as we have already seen, the accept and reject rule is simply based on the comparison of ARR of the two machines. So, from this we can know which project is doing better. So, here the answer is project B or machine B, but decision by the management will not be taken only on the basis of a comparative chart of ARR of the two projects, but here the cost of capital of the company would be compared with the ARR of the two machines. If the ARR of the two machine is better than the cost of capital that management has calculated based on the cost of financing, then only the decision would be taken. So, it is not just the comparison of ARR of machine A or B, but it would be considered in comparison to the cost of capital, that is also known as the cutoff rate or the hurdle rate. Now, we can see the evaluation part of this ARR method. What are the merit, what are the demerits of this project. So, here method is too simple because it is drawing the information from the balance sheet and the income statement, but the same simplicity of the method can also be seen as the demerit of the project, because the financial account suffer from so many limitations. So, that would automatically come into the process of calculating ARR and deciding on this basis whether to select a project or to reject a project. Besides, one of the serious limitation of this merit is that it ignores the time value of money. So, every rupee, whether it is generated in the year 1 or year 3, is taken in the same manner. So, that is not true when we have to measure the true profitability of any company. Secondly, it is also based on the accounting profit and do not consider the length of the life of the projects, and it is also a method which is not able to distinguish between the project with different timing of return and outflow, as we use average profit and the investment. If we look at the pattern of income generated from the project, just look at the machine A and machine B. Machine A is giving an income which is deteriorating over the years, whereas the machine B is generating an income which is on an increasing trend. So, this is also a very important things which should be looked after by the management when deciding about the quality of the project, but this cannot be used as a measure of true profitability, because we are not using the discounting method or we are not considering the principle of time value of money. So, that was the ARR as one of the non-discounted method for evaluating the long-term investment proposals. Look at the second technique, which is known as the payback period method. As the name is suggesting, it is defined as the period required for a project's initial cash outlay to be recovered by the future additional cash savings generated from the proposal. So, here it would represent the length of time which would be required for the sum of the net cash outlay to become equal to the net cash benefit coming out of the project. It is very important technique for ranking the projects. Now, let us see what are the formula, what are the merits and demerits of this method based on some numerical examples. So, here the formula says that net investment outlay divided by net cash benefit gives us the number of years within which the initial investment would be recovered. The accept project rule says that lower the period, better is the projects. So, let us see with the help of one practical problems. Here again we have two projects, project A and project B, where these two projects require an investment of rupees 2000. The net cash benefit or the net cash flows from the project A and B can be seen in this table, where project A is generating consistently rupees 500 over 6 years, the project B is giving 400 rupees during next 6 years. Now, the management has set a cutoff period as 4 years. Now, we have to see the solution whether the project A or B qualifies to be selected as the project by the management. So, if we have to use the same formula, that is NIU upon NCB, payback period for project A comes out to be 4 years, because 2000 that is the NIU divided by 500, we get 4 years as the answer, whereas the payback period of project B would be 2000 divided by 400, that is the annual cash flow, it comes out to be 5 years. Now, it is very easily can be compared that project A is having lesser payback period method as compared to project B, and if the management has to decide, naturally it goes in favor of project B. Payback period method would have a distinct formula when the cash flow is not even as the previous case, but it is different in all the subsequent years. Now, it can be seen from the another problem, and just look at the initial investment, it is 14,000, where the cash flow can be looked at from the table, which is 2,500, 3,500, 4,000 and so on. So, 8 years gives us the different amount of cash flow. So, how to solve this problem? How to find out the payback period method when the cash flow is not even? So, in this problem can be solved by preparing another table, which is known as the cumulative cash flow table. Cumulative cash flow means the second year's cash flow would have the summation of cash flow of the first year, and this process will continue unless we are reaching to the last year, and from this cumulative cash flow table further we have to see that in which year the initial cash flow has been recovered. So, just look at the table and the part which shows us the cumulative cash flows. In the first year it is 2500, but towards the end of the second year the 2500 of the first year and 3500 of the second year gives us the cumulative cash flow of rupees 6000. Subsequently, in the third year if we add the cash flow of the 4000, the cumulative cash flow reaches to a point of rupees 10,000, but still we have not reached to the point where the initial cash outlay or initial cash outflow has been recovered. So, can we see the cash flow of the fourth year? Yes, it is 4000, and by adding this 4000 available in the fourth year, we are getting the cumulative cash flow as 14,000, and just look at the initial investment outlay, it was 14,000. So, now we can say it is in the year 4 that we have been able to recover the 14,000 that has been made available by the project. So, now we are considering only 4 years up to which the initial investment outlay would be recovered. But what about this cash flow of the subsequent years? What about the cash flow generated after the cash payback period method? That is going to be discussed when we discuss the merit and demerit of the payback period method. So, one of the greatest advantage of payback period method is that it is very simple to understand, and it is also very easy to calculate, and the project is also giving us a quick method to find out the project which is more viable if we are comparing the two mutually exclusive projects. Then this method can be useful for those companies where the funds are limited and it has to select the project which is going to give us the speedy recovery of the initial investment outlay. And it is also important for those projects where the obsolescence and liquidity of the investments are of important considerations. The industry where the technology is changing very rapidly, it is also useful for those industry which is witnessing a very rapid advancement in technology, so that the company it recovers the initial outlay, sold out its machinery and gets the new one, which is very relevant and contemporary for the present situation. When the uncertainty is there, again this method can be of very helpful, but the demerit of payback period method can also be considered when we have to choose this as a method, foolproof method for evaluating the long term investment proposal. So, it is not measuring the profitability of the project, because it is not considering the time value of money principle, and that is the demerit, or that is the flaw which triggers finance manager to find out a refined version of the payback period method, and that is how there is another version of the payback period method which is known as the discounted payback period method. So, in this case, instead of taking the absolute value of cash flows generated from the project, the future cash flow would be converted to their present value, and then the cumulative cash flow table would be prepared. So, what is the present value? We have also discussed this concept. This present value represents the current worth of the future sum of money or an investment given a specific rate of return or discount rate. That means, the present value gives us the idea, like if the money is received say after 2 years, 3 years, what is the present value of those money received after 2 years or the 3 years. So, the process of calculating the present value can also be done with the help of a PV table. Here, look at this table, it is having 1%, 2%, 3% and so on. This is the rate of interest that the company is expected to pay to its supplier, and that is how this is also known as cost of capital, and this is also known as the discount rate which is used to discount the future cash flows to its present value. And here on the left side, the years have been mentioned, the year in which the cash flow is being generated. So, if we take one example, then we will discuss how this table will be used to convert the future cash flow to their present value. The initial investment is 10,000. Discount rate or cost of capital or WACC in this problem is 10%. The cash flow coming from the project is 3,000, 3,000, 4,000, 200,000 and 2,000 in 5 subsequent years. Now, instead of just preparing a cumulative cash flow table, taking the absolute value of the cash flow generated in all 5 years, it is converted to their present value. So, here how this is done, the table 1 column 1 shows the year in which the cash flow is being generated. Second column represent the cash flow from the projects, and the third column is giving us the PV factor at 10%, where from this 0.909, 0.826 is coming. Just look back to the table. If you consider this 10% as a cost of capital, so you see the year 1, year 2, year 3, 4 and 5. These are the PV factor which if multiplied with the cash flow would be able to convert the future cash flow to its present value. So, 3,000 would be multiplied with the PV factor that is found out at the intersection point of the year and also the rate of interest. So, at 10% in the first year we get 0.909. If this PV factor is multiplied with 3,000, we get the discounted cash flow value as 2,727. So, this is the present value of cash flow generated in the first year. Second year gives us 3,000, but it would be multiplied by the PV factor that we get at the intersection point of 10% in the second year. So, it is 0.826. If we multiply 3,000 with this PV factor, we get 2,478. We can also look at the pattern. So, higher the length of the period in which cash flow is being generated, it lower the present value of the cash flow. So, here then we will prepare a discounted cumulative cash flow figure just as we have done in the previous problem. So, 2727, it is the cash flow of the first year. Adding to it 2478, we get 5205. So, in this way we can see that cumulative cash flow is giving us 9,575 rupees in the fourth year, but still we are behind to 10,000, that is the initial investment. So, in order to recover the full 10,000, we have to take some cash flow from the fifth year. What is the cash flow generated in the fifth year? It is 2,000. So, only a part of it would be needed to recover the initial investment outlay. So, let us see how this process is be completed. After 4 year cumulative cash flow is 9,575. Additional amount required to recover NIO is 425. Now, since in the year 5th we are getting 2,000 and the year 5 discounted inflow would be 1242. So, this is the 1242, that is the discounted present value of the cash flow generated in the 5th year, and we want just 425, and this is the 0.34% of the total cash flow generated in the 5th year. So, discounted payback period can be referred as 4 year plus 0.34 years, that is a fraction of the cash flow generated in the 5th year. So, the discounted payback period methods comes out to be either 4.34 years or 4 years, 4 months and 16 days. So, this is the period which is required to recover the initial investment of rupees 10,000. There is alternate method which is very simple to make you understand. It is like if 1242 is generated in 365 days, then how much days will it require to generate 425. So, this way 425 multiplied by 365, that is the total number of days in a year, would be divided by 1242, that is the total cash flow generated in the 5th year. So, we get the answer as 124 days, and if you want to convert these days into years, months and days, we get 4 years, 4 months and 16 days. I hope the process of first of all discounting the cash flow to its present value and then preparing the discounted cumulative cash flow table, it was very easy and you all have understood the process, and then finding the exact number of days, months and year to recover the initial investment outlay. This is the formula that you can say year until break even plus the unrecovered amount at start of break even year divided by the discounted cash flow in the break even year. This is how we can calculate the exact number of year, months and days to find out the payback period method. If we look at the merit of discounted payback period method, it is going to consider the time value of money because of the discounting process, and the merit of payback period method is also arising from the fact that it is focusing more on the liquidity rather than on profitability. So, here a payback period method can be calculated to find out which project is giving quick recovery of the initial investment. As far as the demerit is concerned, it is ignoring the cash flow which is arising from the project after the payback period method. And how to find out the standard cutoff period? It is based on the discretion of the management. So, there is no foolproof way how to set a payback period method which is just sufficient to see the profitability of the project. A project which is giving better cash flow after the payback period may be a better project if you consider the total profitability of the projects, but that is not considered under even the discounted cash flow payback period method. So, these are the merits and demerits. I hope you have understood the average rate of return method, which was based on the accounting rate of return, payback period method in 3 different scenario. One, when the cash flow is even; second, when the cash flow is uneven, but both of these methods are not discounting the cash flow to their present value, and that is how the third version of the payback period method have been devised, which is known as the discounted payback period method. I hope you have liked it, you have understood the whole method. Thank you so much.